Quite simply, here are 2 reasons to invest in Alibaba and 2 reasons not to. Hey everybody, my name's Connor and welcome to my channel Trade in Places. My aim is to help you take advantage of the stock market so your money can work for you so that you don't have to. In this video, we're going to quickly cover the best 2 reasons to invest in Alibaba and 2 reasons to be cautious. Firstly then, the fundamentals look good, if not great. Although the stock of Alibaba doesn't scream undervalued compared to their international e-commerce peers in the shape of Amazon, JD.com, Mercado Libre, Alibaba's shares do shape up well. Alibaba's revenues and earnings are expected to accelerate and grow by 47% and 36% this year after receiving a sales boost due to the pandemic. Yet given Alibaba's stock price has dipped due to the Ant Financial stumble and delisting threats, the stock now has a forward PE ratio of only 21. Alibaba has never traded with a PE below 20, and given that the company expects to grow their earnings by an average of 24% per year over the next 5 years, the stock should almost certainly trade higher in the future. In fact, over the next couple of years, I wouldn't be surprised if the stock grew in tandem with its annual earnings growth of around 24%. The second reason then that I just made Alibaba my joint largest investment is just how well diversified their business is becoming. This diversification has been possible because Alibaba's e-commerce platform is a lot more profitable than its competitors. They don't have fulfillment centers, instead opting for a website platform that connects buyers and sellers, and because of this, their expenses are a lot lower than Amazon and local rival JD.com. Due to these higher gross margins, Alibaba's e-commerce business is extremely profitable, unlike others that still operate at a loss. This has created a strong financial situation for Alibaba and has allowed them to invest heavily in various other business ventures, which are clearly starting to pay off. For instance, cloud revenue recently grew 60%, L.me, Alibaba's food delivery business, grew 45%, Alipay grew 20%, and their Southeast Asia subsidiary Lazada continues to lead within one of the fastest growing e-commerce markets in the world. Chuck in the fact that Alibaba is now the 3rd largest digital ad seller in the world, and the company's revenues look increasingly well diversified. But now on to what concerns me, and firstly is the fact that competition is definitely getting tougher. For years now, JD.com has played second fiddle to Alibaba. However, analysts are suggesting that the many years of investment that JD.com has put into building its own fulfillment network may start to begin paying off. Alibaba has been able to use its profits to fund growth in other industries. However, analysts are suggesting that JD's end-to-end infrastructure will eventually give them the edge over Alibaba within e-commerce. And it's not just JD.com that Alibaba has to worry about. New arrivals such as Bilibili or Pinduoduo are growing rapidly, with Pinduoduo expected to surpass Alibaba in terms of active buyers within the next 12 to 24 months. Not only is competition heating up in China, but their e-commerce market is the most mature in the world, and therefore growth is expected to plateau sooner than in Europe, America and Africa, which should also be a headwind for Alibaba. My only other concern for Alibaba, although it is a big one, is the increasing regulatory pressure from the Chinese government. The Chinese antitrust regulator recently suspended the IPO of Alibaba subsidiary Ant Financial as the government aims to halt monopolistic practices by big tech companies. It's not just the local regulator that Alibaba has to worry about. The US recently announced that all Chinese companies will have to comply with new auditing rules to avoid being delisted from US stock exchanges. Although it should be easy for companies to merely alter their auditing procedures, Alibaba's reporting standards have concerned investors for a number of years, and although unlikely, if this were to cause an issue and Alibaba were to get delisted, then this would be absolutely disastrous for the stock. Quick summary then. I love the fact that Alibaba is at the heart of various growth trends, including e-commerce, online advertising, cloud payments and streaming. Therefore, it's no surprise that Alibaba is expected to deliver impressive growth for years to come. And if all goes to plan, then I believe that the stock will almost certainly be worth more in the future. However, competition is getting tougher, and it's very much China's version of how retailers are finally starting to hold their own against Amazon. The US and Chinese regulators also appear to want blood, and that's a fight that nobody needs. I hope you enjoyed this video. Remember, this is not financial advice. I am buying shares in Alibaba, but you don't have to. Before you go, please click the like button. It takes like a second, so unless unless you have a fear of like buttons, then please show some love, like and subscribe. It really keeps me motivated to produce more videos, and I've got lots lined up that can hopefully help you guys make some money. So stay tuned for those. Obviously, if you click subscribe, then you'll know as soon as they come out, and that way you can take advantage and act quickly on the upcoming growth stocks that I'm about to cover. In the meantime, check out my website tradingplaces.com, and remember that your money should be working for you and not the other way around.